Yeah, I keep hearing this term performance obligation. It makes it sound like a bad, old late night type of movie or something. I don't know. It's like repeated over and over, oh my gosh, what does this mean? From Rea Associates Studios, this is Unsuitable, a management and financial services podcast for entrepreneurs, tenured business leaders, and others who are ready to look beyond the super high culture for meaningful, measurable results. I'm Doug Hauser. The Financial Accounting Standards Board has issued what's being called the most significant revision to the U.S. Generally Accepted Accounting Principles Revenue Recognition Standards in history. Chris Roush, a principal in Rea's Millersburg office, and Katie Snyder, a supervisor in our Wooster office, have confronted the changes head-on to help business owners understand the new standard while uncovering opportunities for new bottom-line growth. On today's show, Chris and Katie will explain the 5 steps of revenue recognition under the new standard, what changes are in store for financial statement preparers, and how the new standard can actually be viewed as an opportunity to look at other areas of potential revenue. That sounds like a mouthful. Welcome, Chris and Katie.
Thanks, Doug.
Thanks, Doug. Thanks for having us.
Now we've got a veteran and a rookie here, and I say that in the podcast sense. Right, despite Chris...
Is Chris the rookie here?
Despite Chris being the veteran of the firm, he's actually the rookie podcast guest, whereas Katie, you're the veteran. So... Little different spin here.
Yeah, long-time listener, first-time caller.
Very nice, very nice. But as we talk about revenue recognition standards, boy, that just sounds overly complex. Just reading that. I mean, I go back to the FAS statements, and I used to have some of those memorized 30 years ago. Now I can't even keep up. So what's going on here with revenue recognition?
Well, previously there was a lot of different revenue standards for different industries across different industries. So there was a lot of disparity between company to company, and the new standard gives one set of principles that applies across the board to everybody. So the FASB is trying to get a little more consistency, a little more clarity, a little more transparency, and more comparability of financial statements between different companies. So that's the idea behind it.
Okay. So the key verb there was trying. So Katie, in your opinion, is that accomplished with this, or did we make it more complex?
In the long run, it will make things more simple.
Okay.
Because as you go from one industry to the other, they are all under the same exact standards and the same rules. While before, in the old system, they would come out with specific guidance for specific industries, and that kept building so many different rules that as you went from different industry, that they were issuing statements that had different building blocks to how they were getting their numbers. Now, when you read a financial statement, they are all following the same 5 principles and 5 steps to reach that end goal.
Okay.
And so it's going to be fun to get there. It's going to be enjoy the journey, but it's going to be a journey to get there. So in the end, it will be worth it.
Okay. So you mentioned 5 steps. Chris, can you kind of go over those? Do you know those 5 steps? Or
yeah, I can start.
You can recite them by heart.
When I miss one. So the first one is to identify it. So the standard is for revenue from contracts with customers is the official title. And the first step is to identify contracts with your customers.
Sure.
Those can be actual written contracts or oral contracts, or just implied by the business and the business type. The second step is to identify the performance obligations in the contract. So what is the customer going to get in exchange from us in exchange for the third step, which is the transaction price? So what have they agreed to pay for it? The fourth step is to, if there are multiple performance obligations within the contract, to allocate the transaction price to each of those performance obligations.
Okay.
Is the fourth step. And then the fifth step is just the timing of the recognition. So contracts, depending on what they are, can be recognized at a point in time, revenue can be recognized at a point in time under a contract or over a period of time.
Okay.
So construction industry is a good example of what might be overtime recognition, because they could have a contract that spans a number of months or even years, and revenue will be recognized over the period of performance of that contract.
Gotcha. But for, I think obviously in the construction world, a lot of them are used to that sort of thinking anyway.
Right.
So are you seeing certain industries that are more, say, unaware or impacted by these changes?
I think in our client base, construction is going to be one of the industries that's impacted the most.
Okay.
There are other like software companies with license agreements and things like that are a 3-year license agreement or something that are impacted by the standard. So there may not be an actual change or a material change in the recognition of revenue under the standard, but the one thing that we will talk about and that all of our clients that prepare GAAP financial statements will see is expanded disclosures with revenue.
Okay. So talk to me about that, Katie. Expanded disclosures. You referring to footnotes and all of that type of thing?
Yes. And this is going to be for all GAAP financial statements.
Okay.
When it comes to the new standards, it is required that revenue is disclosed and broken out between different segments and regions. So if you sell a lot to a different state, say you have 50% of your sales in Ohio, 50% in New York, you have to disclose the breakout, because how that revenue is generated from a user of the financial statements, those revenues have different risks and circumstances. So you have to make sure that the reader of the financial statements are informed. And another area of how they need to be broken out is by like different segments.
Okay.
So I was working with a company on this, and going into it, I was like, you guys have mainly one product line. You're going to be good going into this. I don't anticipate this having a really big impact. And that was a high level surface. When we actually dug down and looked at the details a little closer and understood the different makeup of their revenue streams, they actually had 2 different revenue. It was the same product, but they had 2 different really end customers. So they're required to disclose on their financial statements these 2 different segment lines.
Okay. Yeah, and private companies have some discretion on how they want to disaggregate their revenue and disclose it. Public companies have more strict requirements as far as disclosure, but our client base will have the ability to decide on based on the revenue streams and the users what's the most useful to the readers of the financial statements as far as how they break it down.
And that made me think, for private companies, typically the user, right, is maybe their financial institution, maybe, their board if they have one, or surety provider, maybe another third party, but very, very limited in scope. So can they sort of pass on some of this, or there's no getting around doing this?
If you are required to have GAAP statements, so that's the first question is, do you have a bank or a bonding company or somebody that is requiring financial reporting under GAAP?
Yeah.
Generally accepted accounting principles. Then you have to comply with the standard.
Okay.
Now, for private companies, there are scaled back disclosures from what the public companies are required to have, but you still do have to comply.
Gotcha.
So if there is not that requirement, then you might want to consider tax basis reporting or some other
like that.
Yeah, financial reporting.
But there again, you go back to the usefulness, right, for the end reader. So if they don't have that information, then how useful is it anyway?
So Chris was on
Let's
vacation.
Hear it.
Oh, that, yeah. Go ahead.
And someone in his office reached out to me to help him with this client, and I'm going through like the checklist, trying to understand their revenue recognition and things like that. And then I'm just digging into the details, and then all of a sudden I get an email from Chris, who's out on vacation, and he goes, "Katie, they're on tax basis statements. We're fine. They don't. this guidance doesn't even apply to them." And I was just like, "Oh yeah." Right, that was my rookiness coming out right there.
Thank you very little, right?
Well, they had been at an industry conference, and somebody there presented on the new revenue recognition standard, so they started thinking about it and called us for help, and thankfully Katie was there to answer the phone while I was out. But yeah, I was able to respond to the email, and
they freaked out a little bit.
Yeah.
Yeah, and that's
Interesting.
what we've been seeing with some of our clients that are taking the proactive stance and reaching out to us. And the industry is making it kind of, it's this big change, this big change. Well, let's relax. First, let's identify if it applies to you. So it's only GAAP statements. If
Right.
you don't issue GAAP statements, this isn't a huge concern. And then let's go to the next step. Okay, does it apply to you? Yes. Okay, let's go through the 5 steps, see how they apply, see if you end up in the same spot. A lot of times we're seeing they are. Construction and software, as Chris mentioned earlier, are some of the areas where it gets a little muddy a lot quickly. And then let's go through the disclosures. How does this information need to be presented?
Sure.
So-
Yeah, that makes sense. So really, it's not perhaps as overly complicated at the end of the day in terms of what you're presenting. It's just the path to getting there. You've got to go through a lot of mechanics to determine what's really necessary.
Right. Yeah. And in the disclosures, you disclose how revenue is recognized and also the judgments and assumptions you make to get there. So that's part of the disclosure and why they have to go through those 5 steps to realize how they are recognizing revenue.
The most complicated thing about this, Doug, is it's new.
Yeah.
It's a new way of thinking.
Sure.
So
Yeah, I keep hearing this term performance obligation. It makes it sound like a bad, old late night type of movie or something. I don't know. It's like repeated over and over. Oh my gosh, what does this mean? But for construction companies, for example, they're already used to producing a WIP schedule, and that's part of the financial disclosures. So does it change a lot of that really, or is it just kind of some supplemental information beyond that type of stuff?
could I walk you through an example? Maybe we
Sure.
can maybe do one with construction because they're unique, and then we could do one that's just a
Let's do it.
like a plain Jane. So let's say I was telling Chris I'm gonna go order a chainsaw here recently because I have some trees on my property I want to cut down.
Okay.
So I go out to the internet, I order a chainsaw, okay? And my written contract with the store is for a chainsaw. What's implied in that contract from historically buying things from them, things over a certain dollar point, I get free shipping.
Sure.
So that's implied. So right there, my contract's for a chainsaw and free shipping.
Okay.
So the performance obligations, even though it's not stated in my initial contract, because it's implied the free shipping is, I have two performance items under this one contract. So my contract for the one chainsaw, the two performance obligations are for the shipping and the chainsaw. So let's say I spend $200 on this chainsaw.
Mm-hmm.
So then our transaction price for this agreement is $200. Okay. So then let's go to the fourth step. The way that transaction price needs to get allocated into the performance obligations, it gets divided between the chainsaw and the delivery.
Okay.
Because I have really two agreements here.
Even though there was no true cash cost to the delivery.
Because it's free.
Right.
In parentheses right there.
Yeah.
So
The air quotes.
yes.
Love the air quotes.
So then let's go to the fifth step where you actually recognize the revenue.
Okay.
When the item gets shipped, that's the first item of recognition. So they'll recognize the revenue that's associated with the chainsaw.
Right.
And then upon full delivery, the delivery portion is complete. That's when they get to recognize the revenue that would get allocated.
Okay.
To that.
Interesting.
Now, there's a million different variations to that example. That is a plain Jane example.
Wow.
So
it still seems complex to get there, to go through.
It's a journey to get there.
Yeah,
So,
there you go. Enjoy the journey, right?
Right.
As you said. Yep.
So another contract I am actually in the process of reviewing right now is for the construction. And it's stated in the contract that there are 6 buildings that will be built. 3 apartments and then 3 garages also. Okay. So going through the steps, the piece that I'm getting hung up on right now, and it's going to I need to have more conversations with the client here, is how many performance obligations are. Because depending on the judgment of the company and the end user, I will either have 6 performance obligations or 3. Do you want to take a shot at making a judgment what the performance obligations are there, Doug?
Right. Well, it depends, again, probably how the contract is written and as you indicated, what's implied. I mean, is it implied that the garage goes with the residential unit, or are those truly separate? Exactly.
The crux of what's so complicated on this specific example is, do they really, if they were not building these apartments, would they build the garages?
Okay.
And that is the question we have to identify before we can progress past step 2 on the new standards.
So is this, Chris, are you seeing, when you see stuff like that, does it change the thinking of a client in terms of how they maybe write their agreements in the way they're doing business? I mean, is that something they should consider?
It could, and that's one of the benefits that we touched on. There may be some benefits to this new standard, and I think that's one of them, that they're going to be able to take a step back, because everybody gets caught up in the day-to-day whirlwind and doesn't really pay attention. It's just continues the way it's always been. But this will kind of force a step back to look at revenue, how companies are interacting with their customers, what the agreements say, what the terms of those contracts are, and they can take a look and see if those need to be adjusted or tweaked somehow. Right. I think, like as we mentioned already, I don't think there'll be a big change in maybe how revenue is actually recognized and reported in the financial statements, but just the disclosure of how we get there, what all's entailed, because it'll significantly expand those disclosures that we've seen in the past.
It's more visibility. Now, do you hear any concern on the client's behalf, like, hey, I don't want to disclose that stuff. I don't want to tell third-party users, exactly where my revenue stream comes from.
I haven't heard that yet, but that may be a concern. I think, as we touched on, public companies had to adopt this standard for 2018, so they've already had to disclose a lot of this information, which is a benefit to our clients that are privately held, because we can go out and look at the regulatory filings for their industry or competitors in the industry to kind of get an idea of what's being disclosed, the format, and the information that's being included. And potentially being able to scale that back a little bit, since we're privately held and they have more required disclosures than public companies.
Yeah. Now, Katie, when exactly this went into effect for 2019, correct? Or
That's correct. This standard is really going to cause people to take a step back from the whirlwind of our daily activities, to actually take a look and question where the revenue is coming from. And with that, there's an opportunity that we're seeing come up where clients can actually take a look at their revenue, their different lines now, to take a strategic look at it to see where they want to focus their energy and the resources they have, because there's opportunities there, and they just have to, it's causing them to take a new look at what they see on a day-to-day and go, oh, wait, why aren't we doing this? Why are we spending time over here on Project A when Project B is more in line with what we want to accomplish as a company?
That's a great point. So they can, for those that don't maybe drill down to that level of detail, they can sort of figure out, hey, we're really making a lot more money over here than we maybe anticipated, or than what our intuition tells us. But now we really know, we see the evidence.
Right. Once they start to dig in and actually see the detail behind it.
Yeah, interesting. So that's truly a benefit. Any other benefits that you see to this besides, more time for us, obviously, to consult with our clients? But
yeah, that is a benefit to us, because we're going to be in there talking with our clients about this, getting a deeper understanding of their revenue and their agreements with their customers. We're going to understand their businesses better. Not only to help them implement the standard for financial reporting, but then just to know their business a little bit better and being able to give them advice on decisions,
sure,
and things that interested in.
Yeah. So good stuff from that
Yeah.
perspective. So not all bad news.
Not
you know,
all,
when you hear,
yeah.
you know, everybody hears new regulatory guidance or something like that.
Yeah.
It's always the initial shudder, but in this case, not so bad really.
Yeah.
So good.
Yeah.
Any other client examples that you've seen that are impactful or that you foresee for this next year? Big issues.
You know, we've developed we have a group within Rea and Associates that's kind of focused on this and some different industry specifications. But so we've split some of that up. But we've developed a client questionnaire that all of our team can take out as we meet with clients to go through the 5 steps.
Excellent.
And give them an overview of what the standard is, and the idea is that we would actually go out and meet with them and walk through it so we can dig into more of the detail, because the principles are pretty simple at the top level, but the devil's in the details. Once you get in and start to see what the contracts say and different revenue streams, it's where the complexities pop up. But
absolutely.
that's why we like to be able to meet with clients and walk through it.
Yeah, it helps to sit down and walk through it. Absolutely.
And Chris kind of mentioned that we have different teams here at Rea working on it, and we have one specifically focused on the construction. And Doug, I'm going to give you a shout out because you're putting together a little something in September. Do you want to mention that?
Absolutely. September 20th, we've got an industry forum in Wooster, in fact, but certainly open across the state for attendees, and we'll have CPE available, and I know you'll be speaking there and
one of
enlightening folks a little more.
Yes, one of the team members also who's specifically focused on the construction impact will be joining us to present at that. So we're
Fantastic.
Really excited to present.
Great stuff.
Yeah.
Thanks.
Well, good to hear. Thanks, Chris and Katie, both for being here. If you want to learn more about the new revenue recognition standard or to hear previous episodes of Unsuitable, visit our podcast page at www.reacpa.com/podcast. Thanks for listening to this week's show. You can subscribe to Unsuitable on iTunes or wherever you like to get your podcasts, including YouTube. And while you're there, please leave us a review. I'm Doug Hauser. Join us next week for another Unsuitable interview from an industry professional.